thesis is that gold is bullish. The thesis is that gold will not have a collapse. It will stay strong in the face of all this uncertainty. And it's also a hedge against $34 trillion of debt. You know, I mean, I don't know how else to say it, but it's a hedge on all that. The Chinese are buying strong. You know, there's just so much bullish underpinning here, and there's no reason not to continually rinse, repeat, and exploit it if you can. But as far as the technical is concerned, I continue to keep my focus on this 3,200 because it is the prior breakout point. And it's also, you can see here the VWAP from this pullback, the anchored VWAP brings you into here. And so far you haven't even taken out the anchored VWAP. This is your 21. Your 8 is right here. You're kind of just hanging out at it. But again, this prior breakout level here at the 3,200, this is a buy to me. I already have limit orders sitting here at 3,205 for a starter position for a few contracts. And I would definitely buy more anywhere in here, right? And I know this is a relatively large range, but you know, it's going to be a while before the uptrend line continues, before we get there. And we'd have to have an all-out collapse. But I do think if we get down just to that prior high, that's going to be a bounce point. And any weakness really is just an opportunity to sell puts, but always do it very, very technically. Like for instance, expiring today, we had 3150s, I believe, and then we also did like 3135s, and you know, you can really only do this on a down day, and it just works really, really well. You know, you're looking at these are options on the futures, and you're probably getting anywhere from 70 cents to $1 per contract for a 24-hour period, which is really, really good. Remember, these expire daily, and they expire at 1:30 in the afternoon every single day, which is also, to me, makes it kind of attractive because it's certainly a lot further ahead in time than 4 p.m. Eastern. But that's what I'm going to be looking at there. We are short the 3135s right now in the weekly room, and again, I'm looking for a pullback to this area at the 3200 for a potential long. All right, so there's the charts to watch for this week. A huge basket of ideas. I hope that it's helpful to you, and maybe you can take some of these and make some money with them next week. Time now for a little market profile, one of my favorite subjects, and we haven't had a market profile segment in some time, so I'm excited to discuss market profile with you once again. Lots of nuance here, both above and below, and again, it all kind of points to bullish. Remember, one of the functions of the market profile is to confirm or deny market action by showing you nuances that are not available to you in traditional candlestick charts, and that's really, really important. So right off the bat, first thing to consider is that there's an unfilled gap here in the ES above us, and what's important to note, and again, how this kind of differs a little bit from candlestick charts, is that most ES is charted on a 24-hour basis. So whatever candle you see has the overnight session and the day session rolled into one. But when you chart with market profile, you always separate those sessions, and that's really, really valuable to do. So you can see here on the chart, for instance, that this is overnight activity, and this part here with the yellow value, this is what we call RTH activity. That stands for regular trading hours. So gaps are only gaps when they are gaps between highs and lows of regular trading hour sessions. And so we've got an unfilled gap in the ES above us here, starting from this session back here in early April. So this area here is an unfilled gap. And I say that that's kind of bullish because remember, prices tend to move relatively easily through gaps. We call them like a window or a void, and there's just no value there really. So it's easier for prices to chop through. So that's something to keep in mind. Now underneath us, we're starting to stack a little bit of nuance below us. Like for instance, like Thursday's trade ended on a spike, which put the spike rules into play on Friday. And then Friday opened here, like below the spike, which kind of negated the spike action. But then it did plenty of acceptance inside of the spike, as you can see here, confirming those higher prices from late Thursday, and then closed much stronger than that with not only a settlement at the high end of the range, but a couple of other things that, again, market profile nuance that you would never see on the chart, confirming this bullish action. Look at where the POC was and where the value area was. The POC, which is the point of control, we call that the fairest price to do business. That's where the most volume at any particular price level traded, was very high in the session. We call that POC migration, and it's a good thing. If you're bullish, you want that POC to be migrating higher with price and closing high, telling you that traders are committing to contracts at higher price levels. So that's one thing. And then also what that usually does is causes the value area to expand to the upside. And notice that the value area high and the settlement are one. Usually in a normal RTH distribution, you will not have the value area all the way at the top of the range. The value area, which is roughly 70% of the volume traded that day, will be somewhere in the middle, and you'll have some excess on the top and some excess on the bottom. So when I see that value area extending up to the top of the range, again, it tells me that people are committing volume at very high prices up in the range, and that tends to be certainly more bullish than bearish. Okay, if we look below us, more nuance as well. There was a gap here that doesn't really exist anymore. We can get rid of that, but we can get rid of this. That's the base of the spike we already talked about. But look below us now. Like, we're starting to stack VPOCs. We've got two virgin points of control below us. And also in the 424 session, which was Thursday, there was a long string of single prints here. There was some emotion here. And that's something that is like a poor structure that needs to be repaired. And if it doesn't, you want to carry it forward as bullish. The fact that prices on Friday, and I talked about this in my pre-market perspective video, which I come out with every single morning. It's part of a larger report that I put out to all of my subscribers. You can get it on our site super inexpensively. It's like $1 a day, 20 bucks a month. But people who are in the weekly options room or the live trading suite get the pre-market perspective for free included in their subscription. And one of the things that I talked about on Friday morning was a simple fact that if the market was to stay bullish on Friday, I didn't want to see this single print section tested. And lo and behold, it didn't get tested, right? We did have some wild action on Friday where it was kind of two-sided and we came down to here, but those single prints remained untested, and I'm carrying that forward in my narrative as bullish, all right? So that's kind of nuance one below us. And then beyond that, as I was saying earlier, you're starting to get virgin points of control below you. That means that where there's a fairest price to do business, a high volume node, if you will, that doesn't get tested in a subsequent session, we call that a VPOC. That stands for virgin point of control. And you've got one there from 423, and if we go back down into here, And by the way, I should say before we get to the gap, you've also have an unfilled gap now below.
Order
That's
filled.
a bullish thing, right? You have an unfilled gap here. Again, you can put that in the same column as the structure of like the single prints, etc., where unfilled gaps are bullish. Why? Because it's essentially the market not doing something that it should, right? We call
Order
it
filled.
SHD. That's a term that I coined a while back, which stands for when what should happen doesn't, you want to go in the other direction. And when what should happen here is a filling of the gap doesn't, the market is probably going in the other direction. And that's what we clearly saw this week. So you got unfilled gap as well, VPOC above it. And then, as I was saying, other virgin point of control down in here. Let me see if this is actually another one that I didn't list. This is actually another one here. That's virgin point of control there, 53.14. That hasn't been tested. And I believe, if I've got it right, there's another one here, right? This is also here, and I've got to refresh this data to make it just right. But there's another VPOC there. So you're stacking now 3 VPOCs actually below us. And again, that's bullish. When the virgin points of control start to stack below you, it tells
Order
you the
filled.
not tagging up. It's not going back and tagging up. It's just running forward. Normal markets will sort of expand and contract, from excess, balance to excess, et cetera, balance out to excess, back to balance like that. When that balance doesn't get retested, meaning you're not going back to the fairest price to do business, you can think of that as short-term bullish. So just a few nuances there on the profile that really just, as I said, are just driving the point home in a more nuanced fashion, in a way that that you may not see if you're just looking at traditional charts, kind of pointing to some more bullish action. Just as an advanced heads up, I am right now just finishing up the outline for something that I'm going to call the market profile course. And I'm really excited about this. There's been a lot of people asking me to do this for a long time. And the hardest part of putting this together for everybody is really the planning stage, which is what I'm in right now, is just making sure that I've got every single thing that I know about market profile listed so that I can then record it. The recording is not that difficult to do, but just to give you an advanced heads up, it's going to kind of be broken up down into 3 sections. There's going to be basics to kind of explain what the market profile is, how it's constructed, why it exists, and how it can help us, and all the different components of the profile. Then it's going to move into market profile theory, where we start putting the little patterns together, saying, what's a poor high, poor low, single prints, how does that work, POC migration, value area, et cetera. That's the theory. And then I'm going to wrap it up with some actual examples, which I call application, where I will take a number of trading days and show you examples of how the profile did this and price action did that. Notice that we were looking for price to do this, the profile was here, etc. How the different nuances play out on actual trading days. So I'm pretty excited about that. That should be coming at you probably within a month or so at the most. So look for that on our website. It's going to be called Market Profile Course. So I'm excited for that. All right, so that is about it really on the profile. Again, I do write a report on this every single morning, that pre-market perspective and that video that I talked about earlier in the show. That is all through the lens of market profile. It's really a morning market profile letter. I give you all the value areas and pivots for ES and NQ. I lay out some scenarios of how I think the day is going to go, key levels, etc. There's also a video, as I said before, about 3 to 5 minutes every single morning, showing you basically where I think the market is technically and how I think the day is going to play out using some of this market profile nuance in front of us, right? And again, that's right at the Chiron down below, shadowtrader.net/PPP. And if you are a member of any of our trading rooms, be it the live trading suite or my room, weekly options room, remember that you always get the PPP for free. Okay, time now for our number 1 draft pick. This is where I give you my top idea for next week. And this week's idea, as I alluded to earlier in the program, is Tesla. Starting with a little bit of fundamentals, with the caveat that this really means nothing to me. It's all about the price action of how it's driving. But something jumped out at me at this particular report here, or I should say on this particular report of news. This is a research report here, Benchmark Equity. When they reported earlier this week, they definitely missed on revenues, obviously, and the gross margins came in a little bit higher, blah, blah, blah. None of that really matters. But what is important is this stuff, is that the robotaxi business may be launching in June, probably isn't, you know how it is, they always promise and underdeliver. But this is also interesting to me, has the least exposure to tariffs. 85% of its vehicles compliant with the United States, Mexico, Canada agreement. So that's kind of interesting. And notice that they put a 350 price target on it here, which I'm about to show you why that's interesting to me when I look at the chart. So here's where the rubber meets the road and what's really, really important. I actually posted this chart on X earlier today. If you want to follow me there, it's right there in the Chiron. That's my handle on X. And what I like about this chart is a lot of different things. First of all, the fact that earnings are in the rearview mirror, that's always helpful to me. Friday had a huge explosion to the upside on a big increase in volume, which is good. There is a huge congestion area here that needs to be cleared. And whenever you have a congestion area like a balance like that, the general rule of thumb is that how far it can go is double the balance. And remember that research report put a $350 price target on it. And interestingly enough, if you double this balance area, you get to about 360. So it's kind of funny how they put that right there. I don't think they're using that, but I just find it interesting that there's that sort of confluence between the technical and the fundamental for what it's worth. So if we can break out of this balance area, another reason why I think there's potential to move to here is the fact that if you look to the left of the chart, what have you got? You don't have congestion, but rather you've got open space. This is a straight move down where the stock was just tanking after breaking down lower from about that 330 level. Those areas in the chart where there is no congestion and there's just straight price action down or straight price action up, those tend to be less supportive or resistant as price moves back down through them. So that's what I'm liking as well, is that if we're going to break out above this 285 area, the price that we need to move through looks like this rather than like something like this or something like this. It's just going to be a lot easier. So that's really my thesis on Tesla. We are already long. in the weekly options room. I'm long some shares on top of that, and I would probably buy more on a pullback. It's the same thing I was talking about as well with the whole 821 pinch. Notice that we pinched to the downside right here, and that set up the down move in Tesla. And here we failed to pinch to the upside. We tried to, but we stayed here in the consolidation zone. We didn't actually get enough high prices that would effectuate the pinch, and now we're getting the pinch. Now you've actually got that 8 pinching through the 21. So I think that also, once I see that, I tend to think that put sales are okay, that you've got some security here where these lower levels are secure. We're already short some puts here in the room at the 220. I think, to be honest with you, we would sell more of those on a pullback. Any pullback in this area here, as long as it holds that 821, which is about the midpoint of that congestion area, I'd probably be short more puts. And again, looking for this move here up above this shelf here, moving a little bit higher towards that $350 area in Tesla. So let's look ahead to next week so we can see what economic data and earnings are going to be happening. And it is a heavy week. And I just want to mention right here that if there's anything that could have the potential to derail this bullish action, it could be some of this, because you have some important earnings coming out, and more importantly, some important tech earnings, as you can see here on the chart, some of which could really have a lot of effect on the future. So just keep that in mind as we go forward. But Monday's going to be Transocean, which is RIG is the ticker in the oil and gas space. Tuesday, you've got a consumer confidence number. That's always an important market mover. And then the earnings are hot and heavy. You got BP, British Petroleum, Starbucks, Coca-Cola, Booking, Visa, Spotify, and PayPal. On Wednesday, we're going to get a GDP number and also PCE. Those are very, very important, telling us about the state of the economy, whether or not it's growing or contracting, and also some inflation numbers. And beyond that, we'll see reports from Caterpillar, Microsoft, very, very important, obviously a big one in tech, eBay, and Robinhood in the brokerage space. Thursday will be the usual initial claims. That's always on Thursday. We're also going to get an ISM number that week. That's also a potential market mover. And then again, heavy on the tech earnings. This is sort of that big week where a lot of the Fangman plus T reports. It's going to be Amazon and Apple on Thursday, and those are really, really important. Apple obviously is the largest component in the entire S&P, I believe, and obviously a market mover, so keep that in mind. Also Harley Davidson, Lilly in the drug space, MasterCard, and Atlassian, ticker TEAM, is also reporting on the tech side. And then Friday, we continue with important economic data. We're going to get non-farm payrolls, and more importantly, the unemployment rate. And remember, this is the thing that I started talking about many, many months ago, talking about looking for a move up away from that 4.1, 4.2 area, which would maybe potentially signal that we're headed towards recession, because it is a very reliable indicator historically, pre-recessions, when you get an uptick in unemployment. So far, that has not happened at all, but watch that number very closely on Friday, again, to see if we move a little bit away from the status quo of somewhere around 4%. And that's all for this week. Thank you so much for spending a little bit of your weekend with me. So just to recap some of what we discussed in the program, from a technical analysis basis, the downtrend lines are broken from the all-time highs, both in the S&P and in the Nasdaq 100. We potentially are going to get what we call the pinch of the 8 EMA moving up through the 21. That would be a stronger signal if it was to occur. And of course, that also tells you where the market potentially fails, right? Is that if we get price action next week that takes us back down and we lose that 821 and we come kind of back down into that range, then maybe it's all bets are off to the upside. Obviously, this is a market that is still very much in the throes of headline risk. All right, beyond that, I definitely gave you some good ideas that I think that you can run with, a little bit of action on the market profile, which I feel is confirming what's going on bullishly. And we'll see if next week it's going to be a situation of April showers bring May flowers, right? Because we'll end the month in the middle of the week and move into May, and we'll see if May will be a little bit more bullish, right? New studio still coming at you. I'm still excited for that. Fingers crossed. I'm pretty sure it's going to happen in the month of May. So hopefully these little screen sharing things will be a thing of the past. But I do so much appreciate all of you loyal viewers still tuning in, even though I'm not in the full studio. But again, I'm super excited to bring the new version of this weekend edition show to you very soon, hopefully in the month of May. All right, that's all for now. Be safe out there. As always, I wish you good trading and good night.
Okay, so we're rejecting what? 300?
Candles with the super trend indicator, and it will help you achieve an increase.
We rejecting. And let's see how strong. This is very strong here.
Chart's gonna look like when you get started, when you go into trading view. Let me X out of everything.
They're red.
Sites to change.
One,
So we're doing and Fibonacci candles. And that way
one the same shit.
thing is, both of these indicators are the same. This is a super simple strategy, all right? So we're gonna go in here on indicators, go into search, type in super trend, and you're gonna use this particular super trend, all right? The one written by this person, the Kibon person, all right? Click on that twice, shows up. Now we're gonna make some changes. On the first one, click on settings, inputs. We're gonna change the inputs. The first one we're gonna change is we're gonna make the ATR period 21, and the multiplier we're gonna change from 3 to 1. Okay. Click OK. On the second super trend indicator, go into settings. On this one, we're gonna make this 14, and the ATR multiplier is going to be 2. Click OK. You're all set. Super simple, right? Now, what are the trade rules, and what are you looking for? So let's open this up so you guys can take some notes along. On buy trades, when you're looking to go long, number one, you want both of the super trends to be green. So when you get a buy signal here, that's great, but this is still red. You want to wait till both of these are green, so you get 2 buy signals, right? So both super trends are green. Okay. What's the next rule? That's it. This is how simple the strategy is. All right. And then for your stop loss and take profit, let's have that right. All right. So stop loss will be the bottom super trend. So here, this will be your trigger candle. This is where you're not going to go.
Finally, we got it.
Second up, the bottom super trend.
Okay, so what did we find here? That is very strong. Still outside. So the dip was bought. The dip was bought, and now it's continuing to move. Incredible. Okay, now how we're gonna work on work is
People also with the strategy, a lot of people what they also tend to do, like 1 to 1.5 is great, but what a lot of people also end up doing with this particular strategy is they do their take profit when you get two sell signals. So you could have
Order filled. Order filled.
and this still would have been a good take profit level. So if that's what you had done on this particular trade, that would have gone all the way in here and say, yeah, that would have been almost.
but Don't be playing it because it's the half hour shit.
Set it a winning rate. So now on the short trades, let's go over some short trades. Hey, if you guys are enjoying this video, please hit that like button and drop boom in the comments below if you guys are enjoying this so far. And make sure you subscribe to my channel and hit the bell so you don't miss out on any of my future videos about some more awesome trading strategies, right? Sell trades when you're going short. The exact opposite is true. Both super trends need to be red. Stop loss will be the top super trend. And take risk reward will be 1.
Man.
Show you guys a couple of more examples too. I'll show you guys a couple of more examples as well. So keep watching. So for instance, if we were to go short, there's one green, one red. When you get both red, get in on the next candle. You make your stop loss right here, which is the top super trend, right? And then 1 to 1.5.
Give me 13. Give me 13 now. Fuck it.
That's there. Let's keep going forward. Let's see. All right, so you get another opportunity right here.
Order filled.
For the sell.
For a feel. What the fuck? What the fuck? Shit. Shit. Let's go here. Come on. You're gonna do
Order
that?
filled.
Okay. Now let's just close this. Ah, thank God. Oh. Trading scare sucks. First day back. May 75, now down to 6. We're going over here for sure. I know we are. I know we are.
Inputs, we're going to change the inputs. The first one we're going to change it. Let me X out of everything, and then I'll show you guys exactly how to set up the chart and what I'll do. What settings to change. All right, so this we're doing on the 5-minute time frame, and we're using Hayakashi candles. Okay, not regular candles, Hayakashi candles. The 2 indicators we're going to add. And the thing is, both of these indicators are the same. This is a super, super simple strategy, right? So we're going to go in here on indicators, go into search, type in super trend, and you're going to use this particular super trend, all right? The one written by this person, the Kibon person, all right? Click on
Order filled.
shows up. Now we're going to make some changes. On the first one, click on settings. Inputs, we're going to change the inputs. The first one we're going to change is we're going to make the ATR period 21. And the multiplier we're going to change from 3 to 1. Okay? Click OK. On the second, get a buy signal here, that's great, but this is still red.
Mm.
You want to wait till both of these are green, so you get two buy signals, right?
Order filled.
Both red or green. Okay?
Just like that.
Super simple strategy, all right? So we're gonna go in here on indicators, go into search, type in super trend, and you're gonna use this particular super trend, all right? The one written by this person, the Python person, all right? Click on that twice.
I bought the top. I bought the top. We'll see in a second. I bought the top. I bought in a 96. 96. Let's see how that works. Where is 96 page? Right there. So basically it's this one. Yep. 96. I bought it right there. And I sold it at 92. Yeah, I sold it there. But it came down here to 86. So we played the range. Oh, what did you say? Super trend. Super trend. And super trend times 2. So trend settings.
Changes on the first one. Click on settings, inputs, we're going to change the inputs. The first one we're going to change is we're going to make the ATR period 21. Multiplier we're going to change from 3 to 1.
$21. Okay. What? Oh goodness! Goodness! Oh my goodness! Oh my goodness! What are we looking at here?
On the second super kind of indicator, go to settings. On this one, we're going to make this 14. And the ATR multiplier is going to be 2.
Así me lo da uno menos. Me lo da uno menos. is 21. This is 21. Okay, this is 14. This is the one I want to. No, this is the one. Oh, did I not? Okay, so this is the one. That is 14, 14, 13, 12. Whoa. Uh-oh. We crossing. We're crossing. We're crossing. This wants to go up. No, but you think no pump here. está mejor. Sería 1 y dejar el negrito. Este sería el negro. Mm, no hay un color por aquí, chimba. Este. Y pollo. Puta mano. No se fue. Aquí. No puedo read this. ¿Cuánto le falta? Viejo, qué mal parido yo todavía. 34. Ok. Deja ver cuál es el red. El de 40 es el mejor. You're 2-1. I'm gonna do it right there. Gonna take me, gonna take me. Aquí va a coger mucho. Va a haber impulso para eso. No es un mal. No tengo una chispirispis.
Low, even the gap relative to the performance, the ratio line pulling back indicates a little bit less of that flight about this. What did I just say is maybe reasonable about the S&P 500? Close the gap above, lower high in range, some sort of pullback to maybe close the lower gap and offer a daily higher low, right? DHL shipment. If that's the case, we probably see the tech sector pull back from their local highs as we just saw, and we get some sort of pullback on those names. If the healthcare sector as a laggard can break out as that pullback is taking place, it's going to prevent the S&P from falling literally into free fall, and that rotation is going to start indicating a healthier market. So really watching out for that if that unfolds that way this upcoming week. It's definitely a scenario that I'm prepared to evaluate and say, okay, this is giving me more or less confidence on the pullback, right? Let's take a look at the SMH semiconductors. This is at the do or die zone, excuse me, the high at 211 here. I do like the fact that the overshoot did not yield a lower high, right? So put yourself in the shoes of a trend follower, and what in theory could happen here? You get an overshoot. Technically, this is a lower low. A lower high is the next nail in the coffin to confirm a new downtrend. The fact that we've made it to the equal highs in relatively short order is a little bit more compelling that the sellers do not have what it takes to push prices lower. So at this point, equal high pullback, again, is fine. You would need to offer a higher low, ideally over the top of the gap. In theory, if you close the gap all the way, it's not the end of the world, but it really wouldn't be as clean. It's a little bit deeper than what I would like to see at 193. Let's move into real estate, defensive hard asset, you could say, rejecting towards the neckline of maybe this as a head and shoulders. Not overly concerned. 41 bucks there is your major pivot. It's a lightweight sector, so let's move along. Utilities, also a really lightweight sector, not outperforming, but just still stuck sideways in this range, midpoint, not much to say about that. And consumer staples here, perhaps in a bull flag, right? You could call this bull flag, you could call it daily hammer there. If, again, we're talking about this rotation thesis, and let's just say that, oops, weird zoom there. If we get the breakout of XLP over the hammer high, or just over the top end of this range in here at 82, that could be what it takes to offer the rotation as tech pulls back and not sink the ship in the S&P 500. So the chart really doesn't look bad here out of the XLP yet, underperformed on the week, but in theory, you have massive lows happening here, or equal lows, you could even say. V-shaped recovery, bull flag, call it, higher low like that. Whatever you want to call it, the chart structure is not bad by any stretch of the imagination. So 82, top watch. Will the rotation take place is the key question. Let's move on into our sector ratios here. Let's get a little bit more granular. If you're not familiar with the sector ratio grid or how to set this up, check out the video tutorial in the top right-hand corner. And let's just say the green shoots, they're shooting. If we look at the XLK, notice that not only did we sustain the higher low here, but into the end of the week, we actually went on to produce a higher high. This is a trend reversal out of the XLK ratio, which is a risk-on indication. As we look at the XLY, the higher low is holding, and we've traded just a hair short of the equal high. If this can break out early in the coming weeks worth of trade, that would be very impressive. I'm honestly a little surprised that this didn't happen with the massive outperformance from Tesla on the Friday session, but we'll take that in stride. XLF pulling back has the opportunity to offer a higher low, noting that we are pulling back from a higher high in the trend count. We'll give a check mark here as well. XLVSD for defensive, it's technically making an equal/slightly lower low, not the end of the world, not overly concerned. As we look at the risk-off ratios, these are pulling back, and they're making higher lows still. Higher lows happening still here in the XLU. We're keeping an open mind to these, but as we're seeing the green shoots in the risk-on sectors up above, I think that's, the next thing to watch out for here is a lower high out of these ratios. That would confirm more of the risk-on rotation, confirming more of the structural low being in place, and risk appetite across the market improving. As we look at some specialized ratios here, XLK, SHY, you can see that we have the same story, higher low, and also a break of the neckline here. You can see this as a double bottom. Neckline is in play as soon as Monday of this upcoming week. As we take a look at the XLY, XLP, strong move to the equal high. A higher high over the 50 SMA would then easily set the opportunity for a higher low, and that would be a risk on rotation. Clear higher low out of semis versus healthcare, breaking out over the neckline into the end of the week, looking for a continued move over the 50 SMA, and even the ARK-K fund down here, breaking out of, we talked about it slightly on Wednesday, this really odd looking inverted head and shoulders there, well above the neckline, but most importantly, breaching up and through the downward sloping 50 SMA. Let's take a look at the secondary set of risk on off ratios. Gold is pulling back, well, I should say gold itself is absolutely pulling back, but relative to the performance, the ratio line pulling back indicates a little bit less of that flight to safety or just the sheer outperformance of gold. And oh my goodness, let's buy this. So I think one of the things you want to be careful of there is anybody who's still looking to buy gold as an asset that's going to outperform might want to be a little bit cautious of that. There's actually a really great argument to be made. Let's maximize this and let's go out to a multi-year chart. If you take a look at this, right, and let's just use some horizontal resistance here, this area generally has provided a pretty severe reaction to the downside, and just noting the velocity, so to speak, of how we've arrived at this territory, wouldn't be unreasonable that a pullback here just kind of marks the end of the euphoric move out of gold, especially if you tie that into a lot of the other indications we've talked about so far through the broad market analysis. It doesn't look like the max fear, oh my goodness, let's rush into the safe haven assets. It doesn't look like we're still at that point in the market. Once again, if you think about the MFEU scale, probably moving more towards the right of that scale rather than the left. So you think about Bitcoin, Bitcoin also breaking back up and over 92,000, a green shoot here as well out of the Saylor Shift ratio, indicating that as gold is pulling back, Bitcoin is undoubtedly outperforming as a risk-on asset. As we look at the TLT ratio to the S&P, I love the lower high, but we still don't have that final shoe to drop, which is the lower low underneath the ratio lows from back over here. Still watching that very closely out of the TLT. Let's move into some of the dollar and see what's going on with dollar and rates. A little bit more fundamental here. Dollar's trying to find a little bit of a floor. I think that this is taking place as the comments are, being relieved, so to speak, around Jerome Powell and his position at the Fed. You can see that rates here are going a little bit sideways towards the bottom end of their range. It doesn't seem as though we have any the volatility out of rates, right? We could even fire up. Let's drop in up here the move. I think we have to go GIF. Yeah, move GIF. So this is the bond market volatility metrics. This is the VIX of the bond market. Big pullback over here just indicates probably some more level-headedness out of interest rates, which is better for a bullish market, right? Obviously, uncertainty on interest rates. Whoa, what's going on? Flight to safety, money comes out of equities, more difficult operating environment. As this comes down, sigh of relief, a little bit more bullish, right? The max fear, so to speak, is in the rear view, at least in terms of bond volatility as seen here. Let's jump on over to, we could take a look at gold in isolation, just the chart itself. Notice the shooting star here on a big push to the upside. If this sets some kind of lower high, I think an easy target of gold would just be back towards $3,200 an ounce here as the ratio pulls back as well. Let's move into commodities as a whole. Maybe we can just look at metals here. Many other metals are much more range bound relative to gold, which has clearly been outperforming there. So any big indications from commodities? Probably not on a relative basis to the broad market. Let's jump on into the inverted ZT as we anticipate the Fed tracker tool here. Unchanged, really not much going on sideways, which I think is a great segue. Let's just jump on over into it and see what's going on with the Fed watch tool. Let's see, give this a little refresh perhaps. See if the Fed, there we go. Let's jump on into probabilities, and let me zoom in on this for you so we're not squinting at the screen here. Even one more. There we go. Looks like we are still dealing with 89.6% odds. This has been bouncing back between anywhere from 85 to 93% odds I've seen it as high as for the May meeting, which is fine. We all know that the conversation here is that the Fed is going to continue to pause until the tariff inflation starts showing up in the numbers, which is going to mean at least waiting for April's data, which comes out in May, May's data comes out in June, so on and so forth. So you're probably not looking at a Fed. I would even say that the June Fed cuts is a little bit shaky at this point. I would tend to think that the odds might bounce higher for a sustained pause if there's any inkling of an uptick out of inflation, which, as a matter of fact, we're going to be getting inflation data on Wednesday at 10 a.m. This week. So anyhow, how many cuts into the end of the year is something that we can continue to monitor. 1, 2, 3, 4. Still expecting the Fed to intervene. At least the bond market's pricing that in as of right now. I wouldn't be surprised if this actually turns into less than that. Let's jump on into the the economic calendar rather. Monday is quiet. All is quiet on the Western front. Nothing to worry about on Monday, which is pretty solid, but it gets funky into the remainder of the week. It's the labor report week. You can see that we have JOLTS coming out on Tuesday morning at the 10 o'clock time frame. Be prepared for that. It's the first taste of the labor information. On Wednesday, 8:15, we have the ADP non-farm preview. We are looking for 123,000, previous at 155. We'll watch out for any revisions there as well. GDP numbers get released at the 8:30 time frame. Looking for those to possibly cause some pre-market volatility. Of course, we'll cover that in the pre-market prep when we're all up in the office together. What we unfortunately can't cover while we're together is Wednesday, April 30th, 10 o'clock, PCE as the market's open. That's historically a 8:30 announcement. Someone fill me in the comments section. What's going on with that? But PCE, we're watching out for it. As of right now, the forecast is for a very mild read here at a 0.1 on the month-over-month core. We'll do our best to break it down intraday, but please just understand any hot readings here, and the market is probably not going to like that. Just noting that, and it shouldn't be hot, right? The PCE should be a combination basically of what we've already seen from CPI and PPI this month, so it shouldn't really contain any new groundbreaking news, but something hotter than the expectation, regardless of how you slice it, probably causes a little bit of downside volatility. If we're thinking about the pathing that we've outlined so far, maybe Monday's an update to close that gap in the S&P to the upside. We pull back on Tuesday, lower high could be on the hot PCE, and this is speculation, obviously. I'm not trading based on like the levels will be the levels. Price will tell us what we should do in the reaction at the levels. But I'm just thinking, would it be reasonable that PCE as a hot read on Wednesday could be the lower high back inside of the tariff turmoil zone? It's possible if the read's hot, and it's pretty solid expectation to have to beat here at a 0.1 on the month-over-month. So we're watching out for that. As we move into the remainder of the week, we will get some sustained job information, labor information, jobless claims here coming out on Thursday morning, as they typically do, looking for 224. We actually saw a downtick last week in the continued claims, which to me is an indication that the labor market is doing A-okay, not an issue whatsoever. ISM manufacturing PMI on the Thursday session. That means that ISM services is going to be the next week, early on in May. PMIs on the flash side from the S&P, they came in okay, but the notes on the actual reports from the everyone surveyed, basically purchasing managers, they were really making note of higher costs because of the tariffs and having to basically pass that along to consumers. So we're watching out for that. It's one of the reasons why, again, PCE probably shouldn't have any impact yet from the tariff stuff, but it's definitely coming down the pipeline. As we look at Friday's session, it's the full Monty labor report, hourly earnings, the true NFP government read here, 129 is the expectation, not jobless claims, but the unemployment rate month over month looking for a 4.2, which is pretty stable out of the market. If I just flip back over here for a brief second, then we'll take a look at earnings. I do want to bring up the unemployment rate and just zoom in over here. Let's get that sickness spike off the screen. It's been really stable out of a 4.2. We got a 3.8 was it back here? Yeah, no, 3.9, 4% flat. Regardless, really stable, and what this has allowed basically is the SOM recession rule to pull back, indicating less of a chance for a recession. This would have to be over the 50% mark if that is going to trigger once again. We'll see how that changes on Friday. Back on over to the dashboard for earnings. One of the concepts we've been talking about on the fundamental front is guidance walking forward with all of the tariffs, and if companies pull guidance, that would be a really bearish indication. Now, what you can see here from FactSet's report is that negative guidance for Q2 is actually below the 5 and 10-year average, which is kind of amazing to think about, right? Among all of this uncertainty, the amount of companies issuing negative guidance is right here at 45%. And you could say, like, we're not all the way there yet, and it's still very early, right? You can see it's only 22 companies. So this is subject to change, and we'll see how it progresses. But 45% as of right now, below 57% average on the 5-year and a 62% average of negative guidance on the 10-year. So watching out for that as of right now. It continues to be a slightly surprising metric here that is a little bit more optimistic, I would certainly say, keeping us open-minded to better than expected outcomes, that bullish continuation in the upward direction. Here's the earnings calendar for the coming weeks worth of trade. Domino's Pizza before the open on Monday. Gross, get it out of here. We got Waste Management, pretty solid as a recession-proof company. That would be something to watch out for. WM, see their comments after the close on Monday. But then it's really, if I had to start talking about some heavy hitters here, Visa for the XLF is going to be a big deal. UPS always has good insights, just like FedEx. Coca-Cola, just as a consumer staples company, right? And then, of course, your heavy hitters. Microsoft, Meta, Robinhood, get your popcorn out. Qualcomm, could get your popcorn out for that one as well. We will take a look at Amazon, Apple on the Thursday session. Eli Lilly before the open on Thursday also as a key component of the XLV. MasterCard, probably a rinse and repeat of Visa earnings, but we'll just watch out if there's any discrepancies. Big deal there for our good friends in the XLF financials. Big Bear AI is going to get some probably notable press on earnings. We'll see how that ultimately plays out there. What else? I think that's really it. That's all I'm focused on for this upcoming week's worth of trade. Your heavy hitters, if I had to emphasize just, of course, a few, it's got to be your Mag 7 companies. Microsoft, Meta, Amazon, and Apple all this week should get the market rocking and rolling. Let's take a look back on over to the platform and let's move into some of our additional indications. Bonds relative to themselves. Still not out of the woods on the inflation from tariffs, right? And this is what we've been talking about. This is still in a downtrend here versus this going more sideways here. You can see that we're still over the breakout point. So the longer end of the curve moving in the upward direction relative to the shorter end of the curve would indicate that rates on the long side are moving higher in response to inflation. So that stagflation concern is still absolutely top of mind. We'll see how the GDP prints come out, not really, but midpoint of this week on Wednesday to confirm stagflation or not, or if we should say, oh no, growth is doing fine, and it looks like we'll be a-okay. Let's jump on into, credit spreads, which are a massive improvement. Remember, one of the things we've been watching for is, can we make lower lows? And the answer is absolutely. Lower low happening here, lower low happening here. This helps support the bull case in the S&P 500. Let's take a look at junk in isolation. It continues to move in the upward direction, giving us the bullish divergence on the first go around here, getting some follow through out of the S&P higher on that Friday session, so that's helpful. As we look at Bitcoin, we already looked at it really in the risk on off A, B charts, but over the 92,000, bullish indication here. Let's jump on into breadth. This is your thrust, big move from oversold basically, and this is not the same as the Zweig breadth thrust we mentioned in the intro and that study set there, but generally it echoes the same sentiment where you can see what was really oversold, is right back to now unchanged and even positive. Notice that we have a positive 13 on the week out of new highs versus lows, moving averages both moving in the upward direction here. It is a helpful indication for markets broadening out the rally and not just seeing a handful of names responsible for the uptick here. RSP moving in the upward direction really has a tough battleground though at 172. We'll be watching that very closely. If the S&P can, well, let's say that the S&P breaks out through this, right, as the RSP makes it into 172. If this pullback happens, you need to sustain the higher low above as this sets a higher low here and hopefully breaks out after a higher low is produced. If there's just a straight shot through 172, no concerns for the S&P. Moving along to the QQQE for the equal weight NASDAQ, you're already through the level. It's much more bullish here out of the NASDAQ side of things, concentrated in tech. If you take a look at, we can look at industrials versus transports real quick. Transports ideally get up and out of this range. It's something to continue watching. One of the things that is, we're in somewhat of a different world, right, where it's not like goods moving around is the core. To some degree, the cyclical side of the economy is, but it's a much more service-based economy now. So is the Dow transport theory really all that useful? I mean, there's a reason why we've skipped it in like a majority of videos over the last little bit, but for the bears who maybe want a bearish data point to lean into, Dow Jones transport's not really playing nicely with the remainder of the thesis there. Let's check in on our good friend, the VIX volatility. So this is where I've got a little bit of a question to pose to you, and we'll answer it together. VIX volatility has moved from its capitulation style like spike here. It is drifting in the downward direction. That is bullish, but the VIX is based on 30-day options, and keep that in mind for just a moment. So this is helpful. I like that it's moving lower. It's definitely more of a bullish indication than a bearish one. But let's take a look at some other volatility indications. And we see the VIX of VIX, which is VVIX, is certainly moving lower. It's back underneath the 103. So again, this is helpful. I like the fact that as the market's moving higher, of course, this is happening. Also, if you just take a look at the Monday breakdown, right? On Monday's breakdown, when you made the equal low, you actually had a lower high here in the VIX, right, relative to the previous, actually it was like way lower. This was the previous equal low that we were just describing out of the S&P. So this is helpful. This is all bullish. It's all very, very bullish. But in the intro, I said that there was one more signal that needs to happen, and that comes from this. This is your behind the curtain look at volatility. Now, don't get me wrong. It's strong steps in the right direction, but the one-day VIX is what I'm talking about. Let's take a cruise on over to our good friend, the SPX, and let's take a look at the options data here. Let's close up some of these, and let's go to a 30-day. Oh, look at that. It's conveniently open because I was doing my homework. 30-day out options. What does it look like in terms of, this is your volume column. The next one over is open interest. Let's take a look at the put side, because ultimately this is kind of where, the VIX is being determined from. There's not even enough volume on the put side 30-day out in the S&P. This is the SPX. Okay, Matt, that's like a really expensive product. Nobody's transacting 30 days out on that. Okay, let's go to the SPY. Let's go to the SPY. Let's take a look at roughly 30 days out to the end of May. What do we have here? There's some volume. There's some transactions taking place. This is the call side. This is the put side. Let's take a look, right? But then come on up to something like, obviously, Monday is the next expiration that's closest. Does the volume even compare? It's not even close. All of the volatility metrics that we should care about is the amount of volume that's transacting in the short-dated expirations. I mean, if you were to look at, if we could still pull up the history for the zero DTEs, can we actually get maybe today's option statistics down towards the bottom? Let's go here. Yeah, there we go. So, I mean, I'm not going to be able to parse this out as to volume per strike, but 10 million options contracts went through on the S&P, and I would have to imagine that a decent majority of them were at really short-dated expiration. So the point I'm trying to illustrate is that although the VIX is certainly moving in the downward direction very substantially, and again, I'm not saying that this isn't a bullish indication. Please do not get my words twisted. This is bullish, moving from over 40 to sub 30. Bullish indication undoubtedly. Even, I think the more respected move is from over 50 to under 30. That is historically going to mark an internal low in the market, right? So bullish here, undoubtedly. But is it really when all of the volume that's transacting is in the short-dated expirations? Look at your one-day VIX. Yeah, I mean, as the market broke out on Friday, it made a lower wick underneath 2145, but I don't know about you. Yeah, it looks like a descending triangle of falling wedge, not really a falling wedge, but a descending triangle, absolutely. It looks like it wants to move lower, but it has not yet. So that is, I think, the final shoe to drop here to truly say, like, okay, we're out of the woods. Let's relax a little bit and maybe look for this grind to start in the upward direction. As you take a look at the volatility futures, contango versus backwardation, we're still in backwardation. So once again, are we fully out of the woods? Is it like, oh my God, let's party and let's move on up to the all-time highs? Not really. I mean, you're still in backwardation here. And we can even take a look through the lens of the VIX futures. If I just show you this curve down here, let's get a little scroll. There we go. We're still in backwardation. This, if this is going to invert and do something that looks like this, great. You can actually see that there's a little bit of contango between the June and July contracts, a little bit less volatility between June and July. This is a small uptick here, but generally speaking, the curve is still lower. If this can invert and ultimately do something that looks like this, that's where we start feeling much more confident about that grind in the upward direction. So really, volatility continues to be the final shoe to drop in terms of confirming a majority of the indications, flipping over to the bull thesis, being supportive of the bull thesis. If volatility can do it, that would really, be the final straw, breaking the bear case and probably indicating that we're not going to revisit the lows, at least in short order. Let's jump on into the core list of companies. Let's finish up today's episode on a strong note, and then 3 trade ideas for you. Nvidia is up first on the chopping block. What do we see? Same concept as the broad market, where if this is a double bottom, it's a higher low double bottom. Most importantly, you've seen the recovery into the Thursday, Friday sessions over 104.75, meaning that any higher low pullbacks here probably keep another higher low on the table. If that's the case, I would look for longs into the equal highs. This is the 90-day pause at 114.25. If we can get consolidation here, call it for what it is. It's a bull flag in the short term, and this brigade bolt to the upside should yield these previous highs back here. Here it is on the hourly time scale. You can see what goes straight up can easily come straight back down, but once again, a hold of 104.75 is ideal for a daily higher low. All the same indications as the broad market, where this did not yield a lower high that sustained itself. The gap did not close all the way. Stronger sellers not here. This is your key line in the sand, 104.75. Moving along to Microsoft earnings this week, so please be aware of your options implied volatility. You're getting much more of a range in this box down here, maybe double bottom if you want to call it out like that. Over the top end at 392 could yield the major lower high threat above. Why is that major? Because as we zoom out, all this overhead supply exists up here at 403.25. So we're watching out for that. The other thing, just like Nvidia, is that this move is fairly straight up. Very, very strong day on Thursday. So if the consolidation is going to take place ahead of earnings, I would love to see a potential hourly higher low at 384.50. If that fails and we get a lower high underneath, a daily higher low at 377.25. Why 377.25? We've been talking about this for quite a bit. Previous lows from back here would then have the opportunity to act as support. If we fail 377.25, obviously looking for the gap to close down below, and anything goes after earnings. I will not have a position on through earnings. I never do. It is a gamble, right? You have implied volatility crush working against you. You have theta crush working against you. 50-50 shot higher or lower. It's market expectations. You can do all the math. You can do everything in the world. Unless you're going to move outside of the market maker expected move, your options will be crushed. If you are trading directional singles on the long side, short side, meaning just long calls, long puts. If you have some sort of spread on, that's a different story. You do you. That's outside the scope of, we're not going to sit here talking about spreads and the strategy for that all day. The technical levels will prevail. Here's the Apple chart. Excuse me. Lingering today. Apple chart. Another one. My apologies, folks. If we could stay over 200, that starts to look really compelling for a higher low in the trend count. You have lows, you have higher lows, you have higher lows. Also over the 90-day pause high. This is the pause on the electronic tariffs, which was like, again, the very, very confusing in terms of what tariffs are being applied to what and who has this and who's in trade craziness. So if we could stay over 200, that would sustain a higher low. Gap fill reversal gets interesting, or the straight up grind into 213 is also interesting, noting that the hourly time scale, and just to give you a level here as well, helper perhaps at 209.50 would be what I throw on the chart here. Let's do that together. Beautiful. Over 209.50, you're looking at continued thin structure retracement and then a gap to close overhead at your daily 50 SMA. That's over 213, closes at 220.75. Apple in nature is more of a grinder, so don't expect this big, big green bullish bar unless there's an actual catalyst on Apple itself. That's that one. Let's move on to Amazon. And again, earnings on Microsoft, Apple, Amazon, and Meta, which we'll get to shortly. Let's get into the daily time frame chart first. This is just the balance range down here. If we can break out over the neckline of the double bottom and recapture this previous area of support, which can now act as resistance for that weekly lower high, 192.25, that would start to become more compelling. You have to get there first, and then you have to break through it. I would say that any consolidation here over 183.50 is looking pretty decent. Let's go on down to the hourly time chart to see that. You can see here, previous resistance, overshoot on the gap up, then resistance here, resistance there for your brigade bolt underneath. We can recapture that, the opening print of this session as well. If we could stay above that with confidence, that's where I would start thinking about that higher low thesis. Anything underneath is all about the gap close, of course, and anything goes Thursday after the bell with earnings. Keep in mind that the IV might not even be worth trading, Monday, Tuesday. The IV could be so pumped up that, the bang for your buck may not be worth it. So just be mindful of that stuff out of Amazon, but the technical levels still prevail. This is your major weekly lower high threat. This is your key hold on the daily time scale if we're going to stay outside of this as a range underneath us. Let's move along to Google, who reported earnings. I think it's worth calling out that Google reported pretty positive news on the ad front, with their earnings, which is kind of counter to the idea that a recession is either underway or about to be underway. If companies were really feeling it, right, an easy way to start reducing costs is to just stop marketing, right, or market less. So that's not really taking place. We also saw that the jobless claims last week were out of control. Another easy way to reduce costs, right, is to reduce headcount. So none of that's really happening here. So just sort of tying it into the fundamental conversation we had about the recession. If the Google chart pulls back, let's go to the daily time scale first. The double bottom neckline wants to act as your support, which is starting to step up as of Friday's low. Even the gap fill reversal I would qualify as being within the realm of possibilities there. So if we could hold up over 159.65, I like the double bottom reversal. I like the higher low over the neckline. Consolidation here, then starts talking about upside targets over 166.35, 170.25. Here it is on the hourly time chart. I just want to point out the thin structure on the way down, right? So if you could, this is another Stevie Wonder candidate actually early on in the Monday session. If you open under 163 over 161, a quick squeeze over 163 could easily get you back up here through the thin structure on Friday, fading all morning, and into this previous high at 166.35. That would be a trade that I watch out for early on in the session. For anybody who doesn't know what I mean by Stevie Wonder trade, you're going in off the open and you're sizing the position for zero. You're using options, and whatever you put into the trade, the premium paid is your risk. So if you want to risk $100, go find a $100 call option or two $50 call options and look for the market to squeeze out through that. If it doesn't work and it fizzles out, you probably shouldn't let it go all the way to zero. You might just want to start stopping out of it under previous day's low. And again, you have to do this only if you can actually manage the trade. You have to be comfortable with the amount of risk, but that's what I mean when I say Stevie Wonder. Dollars in the trade is your risk premium. If you break out, great, it works out. If it doesn't, then no harm, no foul. Let's take a look at Metaverse. Let's see what's going on with Meta. They have earnings, as we just mentioned, so be prepared for that. IV crush as well. Generally, this chart looks much weaker than some of the other ones. I don't like the fact that it's so far off of its 90-day pause high, which is way back up here at 586. I do like the fact that it went gap fill reversal in sympathy to the Google news about ad revenue not being down. Meta's primary business, of course, falling into that rough category. So watching out for that. Next thing that I would really want to see happen here is a sustained higher low over 529.85 because of the way that this was the scene of the crime that led to the breakdown happening here. Really don't want to see it back down towards these lows, closing the gap. Some may argue like, oh, it would be good to come in and repair the structure and then move higher. I don't even want to see Meta here. It has to hold up over this level if it's even going to be a contender in the face of all these other names, which are far more bullish in the first place. So watching that, I wouldn't try to play the catch-up trade here out of Meta as the market's trying to come out of a low. I would stick with the leaders until the market's a raging bull market, and then you can look for your laggards to play catch-up, right? Let's move into Tesla. What an absolute... I'm not going to lie. I took like this much of the move out of Tesla versus the entire thing all day, rallying higher on Friday. Unbelievable move. Shout out to you guys if you caught it. We were talking about it as the top watch of the day in the pre-market prep over 260. What a clean chart setup. Just an absolute beauty of a setup here. After earnings, no issue on the IV front. Equal highs, breaking out. This was like the ideal target right up towards this high. It went beyond that for another, I think it was another 4% to get towards that high. But regardless, great looking move, great looking chart. I love the idea that this could break out as a balance range on momentum, up 8.89% on the Friday session. If we can get some follow through over this, look left. Look left at this, right? 303 might be a first place for a little bit of a pause, but this bar in particular, I'm really interested in the retracement through that into 326.50, the origin of that breakdown, just like Meta, we could call it the scene of the crime. If this is going to break out as a daily double bottom, I mean, let's just play devil's advocate. There's sort of your balanced breakout rules that gets you closer to this pivot high 360. I'd firstly be interested in this, absolutely, 326.50, but generally speaking, I think that Tesla has an opportunity here to put on a little bit of a showstopper and break out of this range. The 286.85 level, top of mind. If we take it on down to the hourly time scale, you can see how maybe this inverted head and shoulders kicks it all off. Gap fill reversal here on earnings, equal highs. This was an inside bar on the Thursday session, inside Wednesday's range, right? Just everything that could have aligned and went well did at 260 through the daily 50 SMA. No hesitation here, really. A little bit of a hang up on the 5-minute chart, but straight through. You could easily see the argument for a pullback higher low here over this previous high. Even if you were to retrace to 260, I would take another shot at it long there on a higher low out of the range, looking back to the equal high on the daily range, which is here. Right, so really liking Tesla's chart. It'll continue to be a top watch into the coming weeks worth of trade. JP Morgan looks okay. Inside bars up here out of the bull flag breakout, right, if you're to consider that. So all set on that front. This is helping the case for a bullish S&P 500, looking for a move out of the 3-day range for a range expansion, doubling of the range to get you much closer to this last pivot high at 254. Watching that for your upside consolidation here. Not really interested. Let's move along to Netflix, see what's going on with Netflix over here. Just new all-time highs, a beautiful chart setup. I've got to admit, Netflix is one of these elusive names. If you trade the options on Netflix, you know this, but very, very spready. Tends to completely die out in volume after the first 15 minutes of the session. So if you trade Netflix, then kudos to you. There's a beautiful bull flag in here, right? So anybody who took that, fantastic, lovely on the Thursday session. Friday, really strong consolidation towards the highs. I think this is going to give you just a very simple over-under. Underneath the 1092.75, look for the pullback, big retest happening here, Brigade Bolt on the higher time frame, something that looks like that. Consolidation and then bull flag breakout. I would just be mindful of your trade location. If you're a new money long just getting involved at the highest highs, just kind of understand where you're long from, right? I'm not saying it has to pull back and crash and you're going to, get totally wiped out there, but just be mindful of that risk, right? Be mindful of the amount of risk you're taking buying the highest high. So understand that out of Netflix. And with that, we'll jump into the 3 ideas. Some of these are earnings contenders, so please be aware of that. I think most of them are actually. Caterpillar, we're in the heat of earnings season, right? So what can you do? Caterpillar inside bar, bullish 3-bar play over the neckline of the higher low double bottom. Huge thin structure to retrace. I think the most compelling part about this is just that there's thin structure to retrace. So as long as we're over 301 out of Caterpillar, I would be looking for excuses to get long here, trying to move through this ahead of earnings. If you want to play it after earnings, you could wait and see as well. Maybe there's a subtle gap up. Maybe there's a move to here. As long as it doesn't take this out, I would generally think that the name of the game is higher lows, right? So that would be around here roughly. Let's just round down here, 283.50 as your round figure. Okay, so rough support. That one's not precise. 301, 313, 325.25. Those are all accurate levels to the upside. Let's, there's no sense in being imprecise. Oh, I would bring it down just a hair here. I would bring it down to somewhere along the lines of 283. 283 is what I'm looking at. Not this low, but this low from the Monday fake out, if you will, of this week. That's Caterpillar. And again, look at the thin structure. This is why it's a primary idea. Over 301, right? Let's move into Zscaler. Let's get the click. There we go. Look at this chart on a higher time frame. This is take a look at this thing. Let's go to a weekly. Look at this weekly base that's built out here. Even with all the volatility recently, it was unable to make a new low underneath this like 155, 158 area. So all these equal highs, I believe, are starting to act as a pressure cooker top. If the broad market's going to be in recovery mode, there's a gap gap to close over here on the daily time scale. Let's just quickly flip this to a daily chart, multiple years though. Here you go, right? Look at this. From the previous earnings cycle back here, all over the place on this volatility. That's what we're looking for. Thin structure retracement, gap to close overhead. Earnings are further out on this guy. You know, Brigade Bolts over 217. ZS, really, really strong watch here, I believe, based on the technical setup and the weekly base that is in play. If the broad market can get in gear, this is absolutely a name to be watching. That's ZS. Next up, Qualcomm, earnings candidate. Qualcomm, earnings candidate. Let's take a look. Daily time scale. I think that the idea here would be early in the week. If you get a rally rejection, I love the confluence out of the daily 50 SMA and just how precise all of these previous flat lows were. Qualcomm is not one of those high-flying semiconductors right now, so underneath this 150, 150, you know, I would be looking for a rejection there. So if you need a early week trade ahead of earnings and the broad market's pulling back hard, I would say that Qualcomm could be the contender up around this area. I would say that your pullback target is probably the equal highs of the tariff turmoil zone, which is going to be here as an equivalent, which let's just clean up the level, and then we will send you on your way for the session. Let's call that at 143.25 is going to be this, so on and so forth. So that's Qualcomm. A little bit of rally extension, rejection at 150, 150, sayonara at the daily 50 SMA, looking for a pullback into 143.25 if the broad market is bearish and pulling back. That's all I've got for you in today's episode of the weekly watch list, the weekend edition, if you will. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. We will be live, of course, at 8 o'clock Eastern time, as we always are, for the episode of the pre-market prep, giving you a game plan for the day ahead. We'll be up here in the office on Monday as soon as 8 o'clock rolls around. I hope to see you there. With that said, have yourself a green trading week, and I will see you in the next one.
Order filled.
But if you're looking for an amazing premium indicator, I personally use Lux Algo Premium for my trading, and I highly recommend it. Got a link to it in the description below, so make sure you check that out. If you're curious to see what trades I'm actually making, like this trade I posted recently, that got 30% return in just a little over 2 hours, be sure to check out my free Telegram channel and join my All Access Patreon. Links for that is in the description below as well. Now go ahead on one of my other videos and learn some more trading strategies using some of the best trading view indicators. I will see you on the next one. Totally ripped up the charts because see how it keeps continuing. A lot of people also with this strategy, a lot of people what they also tend to do, like 1 to 1.5 is great, but what a lot of people also end up doing with this particular strategy is they do their tape bullshit when you get two sell signals. So it could have gone all the way up to here, so it would have gone up, gone back down, and this still would have been a good take profit level. So if that's what you were, if that's what you have done on this particular trade, I would have gone all the way to here. And say, yeah, that would have been almost a five to one, right? One to five was the reward. But 1 to 1.5, I've noticed is pretty good because there's certain trades that are going to happen that are going to bounce back and stuff like that. And then you're probably just going to break even or take a small loss. But to have a higher percentage of
Order filled.
So now on with short trades. Let's go over some short trades. Hey, if you guys are enjoying this video, please hit that like button and drop boom in the comments below if you guys are enjoying this so far. And make sure you subscribe to my channel and hit the bell so you don't miss out on any of my future videos about some more awesome.
More if I don't want the line, I just want the fucking.
Exact opposite is true. Both super trends need to be red. Stop loss will be the top super trend. And risk reward will be 1.5. This right here, right? And now I'll show you guys a couple of more examples too. I'll show you guys a couple of more examples as well, so people actually
Random crossing for sorting. Not so one.
But here's the thing, right? No trading strategy is perfect. You know, there will be some
Order filled.
So make sure you back test it with whatever instrument that you guys like to trade, whether it's forex, crypto, stocks, whatever it is, right? And different stocks move in different ways as well, and so do different forex pairs and cryptos. So make sure you do back test this and see how you guys like it. Always back test
Order filled.
Let's save space here and then look at that number.